This is The Markets. I'm Chris Hussey, and today is Wednesday, March 18th, and I'm here on the Goldman Sachs trading floor with John Storey, who is Global Co-Head of Equities Distribution within Global Banking and Markets. John, thanks so much for joining us.
Chris, great to have you in London.
Okay, John, you have been in this industry for decades. You've seen a lot come and go, a lot of volatility in the markets today. What do you make of it? Do you want to play offense or defense?
I think the market is already somewhat defensively positioned, and I think positioning is more conservative, but the market is fragile. And if you think about it, we've seen the S&P pull back about 5% from the highs, which is generally following the path we've seen with most of these sort of geopolitical oil shocks. So it's already pulled back a little bit. In a downside growth shock scenario, our research department has the S&P pulling back 5% to 6,300, putting on a 19 times multiple. I think at the moment, I'm surprised how resilient the market has been. We have definitely seen clients more conservatively positioned and hedged up. As an example for you, if we look at our gross market value in prime and look at our short macro products, it's the highest level we've seen on the short side since September 2023. Right? It's at the 97th percentile on a 5-year look back. So people have got positions on and are heavily hedged. We have a volatility panic index, which is registering 9.5 out of 10, incredibly elevated readings of volatility and suggesting far more turbulence beneath the hood of the S&P index. I think the biggest thing that's happened in the past couple of weeks is the financial condition index has tightened 50 basis points. That is a big tightening, and particularly given we're not in a true crisis period.
Yeah.
So that's quite dramatic. It's going to be very interesting to see what happens in the next few weeks over the Iran conflict. But I also think that if you see what we've seen thrown at the market on private credit, on energy, on AI disruption, to think we're here where we are now, and the S&P is off 2% year to date. You've got gold and treasuries off 5%, which is meant to be your safe haven asset. You've got China equities and NASDAQ flat in the year. You've got Kospi Korea, which has been the darling. It's off 12% since the peak, but still up 30% year to date. And you've got the FTSE up 5%. To me, the resilience the market is showing just demonstrates the hedges are in place.
Yeah, the hedges are in place. Do you think it's also just sort of a reflection of the markets have become conditioned to absorbing these shocks? You go back the last 6 years, we had COVID, we had an existential banks crisis, we had the Ukraine-Russia war. Last year, we had the tariff crisis and Liberation Day. Do you think markets are just conditioned now that they've seen too many of these things and they're not going to fall prey to it again?
I think that is right. I think the world is looking forward and the market is telling you that this conflict is going to end.
Yeah. Exactly.
So any deviation away from that path, you can see more drama.
Yeah, there's an old adage that investors can't afford to wait for the resolution to a problem they know will be resolved. Okay, John, let's switch to the energy sector for a second and tie it into Europe because you are a specialist, obviously, in Europe. Europe has had time to get themselves prepared for an energy crisis. They've been dealing with it since Russia. What is going on in Europe that gets you either excited or not excited at this point?
So the Russia-Ukraine war was much more about gas. And since that time period, Europe has done a much better job connecting themselves to gas imports. So far more resilient. It was less about oil. This one is much more about oil. So when you really think about it now, we've had 1 million barrels per day taken out of the global market in the Russia-Ukraine crisis. This time around, it's somewhere between 10 to 13 million barrels per day. So it's a 10-fold impact. Europe is short refining capacity. I think the biggest issue here is the second derivative. So jet fuel, all-time high yesterday, gasoline, consumer product inputs, this type of stuff. So if this isn't resolved, that piece has quite a large impact on Europe.
Yeah, it's a great point, the jet fuel in particular. All right, so how does that play into the whole diversification trade? Because in 2025, that was a good trade. Are you still thinking that it's a good time to diversify, or is it a better time to stay close to home?
Yeah, so last year, US, despite I think it was up 15% in total return levels, it was the worst performing developed market, which is pretty extraordinary. When you think about the moves we saw in Korea, the moves we saw in Italy and Spain, European index, they were quite extraordinary. So the diversification theme, a great theme pushed by our research department, played out superbly. In turbulent times, you see a rotation back towards the home market, which is the US. So we have seen some of that diversification theme unwind. I think diversification comes in a multitude of different ways. One is regional and two is sectoral. So, the two themes that we started this year with were rotation from US to non-US markets, which is not to say US wasn't still seeing inflows, but the inflows were greater in international markets. And because the denominator is smaller, it had a bigger effect. The second rotation theme was from asset light to asset heavy. We still think that theme has an enormous amount of legs. So I think at the moment we've seen a retreat back towards the home market. We think the diversification theme will only grow more legs as we progress through the year.
Expand on that asset heavy versus asset light theme, because that's that pro-cyclical theme, I guess. Where are we seeing people execute on that side?
Well, so let's look at the asset light, which is look at software where people are struggling to determine what is the terminal value of this sector. And that's the rotation away from a true asset light where people thought actually that was the safest haven to be. Very modelable earnings, and now coming to question with AI impact and trying to work out what is the terminal value of those companies. The team wrote a piece, Halo, Heavy Asset, Low Obsolescence, which is looking at those heavy assets that are really difficult to disrupt with an AI theme. And that, I believe, the heavy asset basket has outperformed the light by 25% year to date.
That's pretty compelling
so that's
trade.
semiconductors, defense, data centers, mining, materials, you name it.
Yeah, and of course, the minute you get into that heavy asset thing, you're sort of getting yourself away from AI disruption. Where is the AI trade then stand today? Do you still want to be long AI?
Yeah, listen, I think the picks and shovel trade around AI has worked incredibly well. The CapEx spend, as we keep revising up our number, or corporates keep revising up their number on CapEx spend, is playing through in the market. So how can you not be long the likes of the picks and shovels, semiconductors, etc.? We haven't yet seen an earnings impact from AI beneficiaries. It's probably harder to model. I think in the last quarterly results in the S&P, 54% of companies mentioned productivity improvements as a result of AI, but I think 1% mentioned it with regards to earnings impact. But I look at the impact around legacy, antiquated architecture or workflows, it's going to be dramatic.
Yeah, it is going to be dramatic. All right, let's put a bow around it. What's the trade?
When I was here last June, I pressed the European financials theme. It's been incredibly resilient during this period. It's still high single-digit PEs. It's double-digit earnings growth, double-digit shareholder returns, and still going through earnings upgrades. So I like that theme a lot. And then I think the second thing, which we just talked about, is this shift from asset light to asset heavy and the sectors we talked about. So data center, defense, mining, materials, all the equipment spend is just is a great place to be.
Yeah, all that pro-cyclical trade. That would imply you're not worried too much about a recession from the energy crisis.
So our thesis is no.
Right.
Yeah, and I think we would need to see this go on for longer to order to see a growth impact. And even in it with a growth impact, we're still modelling 5% downside in the S&P. And so, yes, with all we've got out there in the arena and all that could impact markets, I'm surprised how resilient the index has been.
Yeah, no, it is. It's amazing. All right, what are we watching for in the couple of weeks ahead?
I think the two things that you've got to obviously keep a close eye on, and one is really obvious, which is the Iran conflict for all the themes that we talked about. And the second is US labor data. We saw a soft payrolls number, and I think we need to watch this really closely as an indicator for A, disruption of the labour force, and B, a growth retrenchment.
Last time I was here, you were also all pumped up because you were going to go see some Six Nations rugby. How are we doing with the latest Six Nations rugby tournament?
Okay, so it's over. It finished on Saturday. The final game of the weekend was France versus England. The score was 48-46 in overtime. If France had lost that game to England, they wouldn't have won the Six Nations. So it was one of the greatest tournaments or Six Nations I've ever seen in my life. If you get a chance to go watch it on replay, you should.
That is pretty amazing because I think last time I was here, you were talking about a game back in the 90s, which was the greatest game you've ever seen in your life. So to eclipse that would have been something tremendous. John, thanks so much for taking the time with us.
Great to be here.
That does it for this week's episode of The Markets. I'm Chris Hussey. Thanks for listening.
The opinions and views expressed herein are as of the date of publication, subject to change without notice, and may not necessarily reflect the institutional views of Goldman Sachs or its affiliates. The material provided is intended for informational purposes only and does not constitute investment advice, a recommendation from any Goldman Sachs entity to take any particular action, or an offer or solicitation to purchase or sell any securities or financial products. This material may contain forward-looking statements. Past performance is not indicative of future results. Neither Goldman Sachs nor any of its affiliates make any representations or warranties, expressed or implied, as to the accuracy or completeness of the statements or information contained herein, and disclaim any liability whatsoever for reliance on such information for any purpose. Each name of a third-party organization mentioned as the property of the company to which it relates is used here strictly for informational and identification purposes only and is not used to imply any ownership or license rights between any such company and Goldman Sachs. A transcript is provided for convenience and may differ from the original video or audio content. Goldman Sachs is not responsible for any errors in the transcript. This material should not be copied, distributed, published, or reproduced in whole or in part, or disclosed by any recipient to any other person without the express written consent of Goldman Sachs. Copyright 2026 Goldman Sachs. All rights reserved.